Hello there everyone, today's video is all about curling. It's a very topical video seeing as how the Great Britain women's curling team have just come back with the gold medal from the Winter Olympics, so I thought I'd do a video tax related but also to do with curling. If you believe that there is such a tenuous link, well, let me tell you all about it. Specifically, just to put it in context, this is all about what we call capital contributions and the taxation thereof. So what are capital contributions? Well, in the UK, we don't see many capital contributions. It's not really a thing that happens. Normally in the UK, in terms of how a business is funded, it's either debt or it's equity. You lend money to a company or you subscribe for shares in a company. Capital contributions tend to happen a lot more on the other side of the pond in America. And capital contributions really is akin to a gift. So you're not lending money, you don't want it back, you're not subscribing for shares or equity, you haven't got a stake in the business, you're just gifting money to a business. Not to be confused with charitable donations where you are gifting money or assets to a charity. This is gifting monies to a trading company. Capital contribution. Now, how is that taxed? Okay, so, like I said, it's more akin to a gift. So you'd think, well, okay, if you're the recipient of this gift, do I pay tax on it? If you're a company receiving a gift of cash, do you pay tax? And this is all about the famous case, famous if you're a tax advisor, the Folkkirk Ice Rink tax case of 1975. Means nothing to millions of people, but quite well known to thousands of tax advisors. Although we don't see it come up that often in practice because, like I said, capital contributions, certainly in the United Kingdom, are very rare. But like I said, it's topical because it concerns the curling club. Now we're going back 4 or 5 decades. Folkkirk Ice Rink operated an ice rink in Scotland, and one of the users of the ice rink was the curling club. So the curling club used the facilities, they rented them out so many hours a week on the ice time from Folkkirk Ice Rink. Now, Folkkirk Ice Rink charged them not the full market rate. They basically did them a deal and said, look, we're going to give you reduced rates to rent the ice for your allocated hours a week for your curling. Don't know what they did with the ice skating crew, but that's by the by. Certainly for the curling lot, they got a good deal. But then, the ice rink was struggling financially, and the curling club got wind of this and said, okay, we don't want to lose out on this facility. These guys are looking after us, they're giving us a great deal, they're hardly charging us any rent for the use of the facilities for us to do our curling. So the curling club gifted £1,500, quite a lot of money in those days, £1,500 to Folkkirk Ice Rink so that basically they would stay in business. And they gifted this money. Folkkirk Ice Rink had that in their accounts, and they treat it as a gift, but crucially on their corporation tax return, they said it's not taxable. This is not for the benefit of the business. This is a gift from one of the people who use our rink. We haven't sent them an invoice for this. This is purely a voluntary payment that they have made. HMRC got all over it and said, hang on a minute, this is for the benefit of your trade. It's related, it's linked, there's a nexus to the trading that goes on for you as an ice rink and the things that you do on the ice. That gift from the curling club is related to your trade. And it went all the way to the High Courts and set a bit of a precedent. Hence the reason why, as tax advisors, it's one of the many tax cases that we learn, the Folkkirk Ice Rink case. And the bottom line is that HMRC won the case. So the Court of Session in Scotland, they concluded, they held that receipt of money from the ice rink that the ice rink received from the curling club was related to the trade of the ice rink, and that the ice rink had incurred expenditure on providing the facilities to the curling club. Therefore, it's only right that they should pay corporation tax on the receipt of the funds from the curling club. Even though this was not, like I said, it wasn't an invoice, it wasn't part of the charge that they gave to the curling club, it was a voluntary payment, but there was that link between the two, and it was for the survival of the trade, to keep the ice rink going. That was the reason that the curling club gave the money. Even though it was purely voluntary, the court said, I don't care, it will be taxed as if it was a trading receipt, just as if they'd have issued them with an invoice and got the money in that way. Doesn't matter the fact that it was voluntary. So they looked at all of this thing and they concluded and they said, it is a taxable trading receipt. So, Folkkirk Ice Rink, all about curling. Now, what about instances where it wouldn't be taxable? So, consider the following. When would a capital contribution not be taxable in the hands of the recipient? So let's say we've got a group company. We've got parent and subsidiary. Subsidiary is wanting to buy a new piece of machinery, let's say £1 million, doesn't have the cash. Parent company is willing to gift £1 million to the subsidiary to buy that piece of kit. So that £1 million goes from the parent company to the subsidiary company. It's not an intercompany loan, because it's not a loan, it's a gift. They don't want it back. They're not subscribing for additional share capital, because they've already got 100% of the share capital. So how do we treat that £1 million, firstly from an accounts point of view, and secondly from a taxation point of view? Well, like I said, it's quite a rare thing as a concept, but it doesn't mean it doesn't happen. So what would you do? So in the books of the subsidiary, double entry accounting, you would debit cash and you would credit capital contribution reserve. So from an accounts point of view, it's sat on the bottom half of the balance sheet, in amongst where all the equity is. Even though it's not equity, but you've got to find a home for it somewhere. That credit has to go somewhere. Debit cash, credit what? You credit the capital contribution reserve. It's a separate reserve, bottom half of the balance sheet. But it's not equity and it's not debt. So that's where it goes. And then when they actually buy the £1 million piece of equipment, machinery, debit fixed assets, credit cash. But you're still left with that capital contribution reserve on the balance sheet of the subsidiary. Parent company can put it where they like, it doesn't matter, because it's added back from a corporation tax point of view. The parent company is not getting tax relief, not getting tax deduction on gifting that £1 million to the subsidiary, but likewise the subsidiary is not paying capital corporation tax on that capital contribution. The capital contribution comes in, it's accounted for as a contribution reserve, sits in cash until it's spent, but it's not a trading receipt. So compare and contrast, unlike with the Folkkirk Ice Rink and the curling lot, totally different. Under this scenario, that again, it's a gift, but it's what is it used for? And it's used for the subsidiary to acquire some plant and machinery, £1 million. It doesn't have the cash, but it's 100% parent. Its parent has the cash, so it gifts it the money. In that instance, not taxable on the recipient, the subsidiary. Folkkirk Ice Rink case, the curling lot, was taxable. So just an overview there on what is a capital contribution. How do you tax gifts to trading businesses? And basically, you've got to look at the underlying causes. What is the recipient going to do with that money? Because it will drive the tax treatment. So I hope you like the video. If you do, please remember to subscribe, and I will see you soon.